What's up everybody, Tom here with another video, and in today's video we'll be taking a look at the week ahead for the markets around the world, including the S&P 500, Nasdaq, gold, Tesla, Bitcoin, and more. There's just been a Black Friday carnage day on the markets, and of course this is due to the new strain of virus. But the question then becomes are we in some type of turning event here in the market where the market will crash, or are we about to see another buy the dip scenario? We'll be trying to answer it together with the community right now. Stay tuned guys, this one should be good. All right, everybody. Well, what better place to start when we're talking about the week ahead than the Friday market? And I can tell you this is a brutalized red session. Look at this. The S&P 500 large companies were almost all down except for healthcare, Moderna, Pfizer, some of the pandemic style stocks such as Netflix, TDOC, those types of ones were green. But in general, look, Apple down 3.17%, Tesla down 3%, Amazon down 2%, even into a seasonal strength, and the finance and energy sectors just getting absolutely belted. When we're thinking about markets right now, though, and before we get into the indices discussion, I want to talk about global bear market checklists. And this is something that a lot of people follow, the City Index, etc. And people look at these trigger points as showing us whether we're in a crashing scenario or whether we're in a massive bubble that's going to pop. Or is this just another one of those scenarios where we expect stimulus to come in and we don't expect a massive, massive blow off of something like 30, 40, 50%? So March 2000, we know what that was. That was, of course, the tech boom. You'll probably never get a reading, but never say never. 17.5 out of 18 in terms of the reading on the bear market checklist. Red is bad, yellow is half as bad. Remember this. Now, before the GFC, we had a 13 reading. Before the pandemic, we had a 5.5 reading, so it really didn't look like we were going into a full-on crash, and you can see the V-shaped recovery we've had since then, thanks to pandemic stimulus as well. And then we have the now reading. So it's actually not very healthy. Look at this, 9.5 out of 18. Not a good number. We're starting to really get up there into the 10 plus scenarios. And this is what has a lot of analysts thinking, is this market overpriced? Another thing that people look at is the Sharpe ratios. And that is whether it's worthwhile investing in stock markets in comparison to other things. We have 11.2 reading March 2020. Now we're getting a 1.4 rating. So it's really not necessarily as good as it once was. And that's why you're seeing a little bit of trimming through Burry's portfolio, Warren Buffett's portfolio, and everybody else. They're all trimming up small bits of their orders, but in general, they're still remaining long because there are a lot of factors such as the Fed, such as stimulation, such as the economy rebounding, and just general FOMO and of course high sentiment that is driving these markets up. And I've talked about multi-year growth here for a few times. I tend to go with Cathie Wood on that one. The idea of optimism is better than the idea of pessimism in the markets. It doesn't always pay to be a bear, but we'll be looking at some key levels through today's video. So let's take a look now at the actual indices on the Friday. You'll notice S&P 500 down 2.27. The reason it's flatlining here is it was a half day of trade, but the Russell 2000 was the standout poor performer. And this is because small companies tend to get bashed around the most, and the Russell 2000 certainly got hit up. It was down as much as 5% through the session, but not all bad here because while it does happen like that, it has a tendency to rebound on the next day of trade. So when you get a big crash, the next day actually tends to be green, and we'll explain why the technicals are leading to that as well. Let's go through here the different sectors. Of course, IBB, biotech, and healthcare leading out. Gold did okay. Energy, financials, terrible, down 3 to 4% on the session. Just wasn't looking that good, and that's because fear spiked, and this was an almighty spike in fear. The VIX index, that is the fear index for anyone that doesn't know, basically the options of the market and what they're averaging out at, we get a monstrous spike here back up to all the previous 2021 crashes after that April period. So any of those massive volatility spikes tended to go up here. Now this makes me again think that we might see a little bit of a decrease in fear come into the market, and then we don't know what's going to happen next, but it may spike back up, and all of this remains to be seen. If the vaccines we currently have are relatively effective, or it's minor, which is some reports are coming out that it may be minor, that's good news for the market. And of course, the buy the dip scenario could really be in play. Now, if it turns out to be more major and we see lockdowns across the world, we see all this reopening play start to get pushed back, then the market will say, where's the stimulation? We need more money, guys. We need the Fed to stop the taper, bring it back. And that will be the next discussion we've got. We've got to remember markets have already priced in 2 to 3 interest rate hikes next year. So that means in 2022, the markets are already starting to price in massive interest rate hikes. Let's get into the technical analysis across the board though, and we'll start with one of the biggest hedges in the world, the dollar index. Here's the DXY. Here's the rejection that we've seen come through in this market. Look at this, massive rejection here. It's come straight back down. It almost looks like a shooting star. And if you were looking to short the dollar index, you would be looking for it underneath these previous lows. And some of the reasons why you're doing that is because, of course, you've got the high, you've got the low, and you've got a bit of a shooting star reversal candle. And more importantly, it actually hit exactly where we thought it would. 97 was one of our main goals for this dollar index over the last couple of weeks of trade. And it got right to just around the area and then sold off. And this is why you never, ever, ever look at a price and say, I'm going to take it straight on that zone. Wall Street's sneaky. They stop it just before. Remember, if a stock, you think I'm going to get $100 for it, maybe it's better to look at that 98 to 99, 99.50 zone. I'd be interested in the comments down below if you guys are already doing that, scaling out of a position and possibly putting your take profits a little bit earlier. Has that saved you in the past? Let people in the community know. It helps everyone out. So DXY, if it does start to bust down, something like the weekly 200 being met by some other moving averages might be a key zone around that 95 area. I think a lot of people will target in, and the DXY will be something that people watch closely. Also the daily 20, you'll notice that's around 95.50 previous support. So people will be looking for lightning bolts, double bottoms, channel style patterns, all those accumulation based style concepts. Now a weak dollar index could mean strength in gold, and we did have a bounce. Look at this. It came off the trend line and bounced through the fear and uncertainty, and then it quickly reversed straight into the Friday session. We're still holding the trend line for now. So a lot of traders will be looking at this 1810 area for a breach, basically creating a double bottom and ideally reversal to show that strength of the trend line, and that would be a fantastic turnaround story for gold traders. It's been a bit of a battled week, but if it does happen, think about what you're doing. Long leg doji, that is a high, a low, and an indecision in the middle. A small rejection candle here, a big rejection candle which came in the Friday session. And if you snap those highs off, you get above the daily 20, which is the red line, get above the 50 moving average, you're above the daily 200 as well, the green line here, and you start that seasonal play. Now, we've been talking about December being strong here for gold for a little while. It ramped up, it fell off. We're about to enter December. Will the same thing happen? 2020, 2019, 2018, 2017, gold, silver, they'll be interesting ones, especially into uncertainty in the markets. We know they tend to spike off that. What didn't spike? US oil. Absolutely terrible. This thing went down really hard, and it was almost looking so good too. We've been pretty good here on oil on the channel. The community's been picking some great zones, so congrats to a lot of you guys. We didn't quite get that last stage of recovery. So let's take a look at the 2-hour chart here to understand what happened. So here we have the breakout. We basically have a trend line down, and we get the first signs of recovery right here. Now we know we have previous support, we know we have resistance support, and we know that this 80 zone or 79.50 to 80 zone is going to be where the real participation comes in. And notice how the market stops just before that and it's unable to breach. This is why we always talk about scaling in technical analysis. The big guys, what they'll do is they might add to their positions here, and then, or they'll start entering with a small position. And then as it breaks through, they effectively reward their trade with their extra positions so that they can scale to the next point of resistance or the next point of support. And this is what we call the participation phase. I really love this phase, and that's one of the ones that I really target in markets. But it didn't happen. It didn't break through that 79.50. Of course, the rest is history. It comes all the way back down here. And now we have to start the repair again. And this is the unfortunate thing in TA. A lot of the time it's sitting back, relaxing, waiting for the next zone. Here's the 50 exponential moving average, the blue line. Here it is. Here's the resistance. We've got resistance. We've got it acting as support. We've got a green line here of previous resistance all over this 65 to 68 area. And again, you're looking for that lightning bolt, smaller time frame, accumulation double bottom, or the channel style accumulation. Even a Wyckoff would be perfect around here. We'll continue to cover oil throughout the week. It's going to be an important one to watch. Let's move over to Tesla and the stocks in the market. Tesla's really trapped. It didn't fall that much. 3% is down a lot in some world, but in Tesla trade recently, 3% is not a huge day. We've gone to 1,200. We've bounced back down to 1,000, and then we've come back up to 1,100. Now, there's no real notables in the options this week. It looks like there's not many puts in the market, not many calls in the market for this particular stock. I believe there's 900 is the biggest strike, or sitting around 900 is where the put wall is. So that is that we don't expect it to get underneath that price this week. But around this 1100 is what we're watching. Day traders will need to dial in on this one. We're trapped in a big range. I believe we're in consolidation, which is something that happens after large moves. So when we get these huge moves, we tend to consolidate for a little while in Tesla and then hopefully move back up to the new high or the new zone. But we've just had 60%. I mean, we can't expect it to continue to dump up 100% every single week. It's just not really the way it works. It usually consolidates for some time. Day traders, 15-minute, 1 hour, and smaller time frames are really going to be where you're looking at. Amazon's another one that took a bit of a dive here on the Friday trade, got underneath the long leg doji, long leg doji, long leg doji. In some ways, decision made bearish. This is a news-based informational trade, a little bit of fear. And when we get these, we have to disregard technicals to a degree from just one particular stock. We really need to look at the S&P 500, the Nasdaq. What is it showing us about the overall strength or weakness in the markets? So here's the previous resistances. We know that this is an important zone. We still believe in the Amazon trade. I think that there is a lot of signs of recovery here that are happening. And one of the things I'm going to do is actually draw the little trend line over here and hope that it holds between these two zones. So not only the recovery position where it's broken through to the upside, but we don't want it getting underneath these series of higher lows. We want it to hold up through here and move up. This will be one we watch after the Monday trade as much as possible. Let's move over to the indices though. We'll start off with the FANG, the big tech stocks. They took a pummeling. They went straight back into this daily 20 moving average, the red line, but more importantly, they snapped off the Thor's hammers. So these are the two hammers that many people are looking at as a positive sign after Thanksgiving and showing us that the market wanted to go up. And in many ways, I feel like the market kind of did want to go up, but it shows that as a day trader, you've got to wait for the confirmations. You've got two massive hammers. Some people call them tweezers. Wait for the follow through, guys. You need that market to show you the momentum up. You don't just buy, or if you do buy, try scaling so you don't get hurt so much by these events. And if the market gets through something like a 5,700 plus, once it's going through there, it's showing you that it's bullish for that session and it tends to continue running. You've understood the tweezer. It's at a great zone, previous resistance, previous support, 20 moving average, all that stuff. But it just wasn't to be. It didn't go through. Good tip if you're wondering. And if you like these types of tips, make sure you subscribe, guys. It does help us out and also hopefully get a lot of value out of the channel moving forward. Here, the market's closed underneath. That is not a bullish sign, of course. It looks bearish in principle. The FANG showing us the first signs of cracks. Let's have a look at the S&P 500, Russell, and Nasdaq next. We'll start off with the Russell 2000. It's come down to the trend line. Bam, bam, bam. Straight into the trend line. Sells off even more to the 220. Pretty brutal day here on the small caps. And then closes right around that zone. For fans of the Russell, it is a pretty good seasonal time for it. Though that doesn't matter when you have Black Swan style news. We're looking for the turnaround. We want the lightning bolt. We want the double bottom here. We want some sign that we can close the gap and move back up here. It was all looking great. We hadn't got the confirmation, and then the Black Swan bit of news comes out and dumps the market. It's pretty brutal like this, but that's trading. Sometimes it happens. We need to regroup, focus on whether we're going to be optimistic or pessimistic in the markets, and the key reasons why. We've got to cut through the FUD and make the right decision based on the available information. And right now, we don't have the full story. We don't quite know how bad this strain's going to be. Some people are saying not so bad. Some people are saying it's good. It's going to be okay. Some people are saying that it's going to be horrible. So we need to find out more. We should know by Monday, Tuesday, some more information. I think the market will react incredibly heavily to that. Let's move over to the Nasdaq. Nasdaq 20 moving average, that is the weekly 20. You know that's the key zone for real bull bear plays. If it gets underneath the 20 moving average, the next real stop is the 50 exponential moving average. That tends to be where the markets go to. They go through the 20, you gravitate to the 50. That's that next stop level. It's not even close to that just yet. We scroll down to the daily. I think it's showing signs of weakness. It's not underneath the previous close over here at 16,000. It's a psychological zone. I'm not too sure that I'm worried about the Nasdaq just yet, but that's because the Nasdaq and the QQQ only show one sign, and that is the tech side. The tech side has done very well during previous pandemic scares and of course during previous Fed stimulation. That's why it is the strongest of the market indices at this point. The S&P 500 is where the real interest comes in because this is more of a general economy kind of statement. Let's take a look at the weekly here on the SPX, and you'll notice again the 20 moving average, it's bounced off it so many times. Should the 20 get breached, which it's not there yet, this is where you expect first buyers to come in very hard around that 4,500 zone. We'll explain that soon. But if it breached underneath the 50 exponential, that 4,200, and that's going to be where a huge amount of participation selling will come in. But let's focus on the here and the now. Let's not talk about the 20 just yet. Let's talk about what's maybe going to happen on the Monday session. So we have the current trend line. The current trend line intersects with the daily 50 exponential moving average. That is the blue line. We talked about how after a big crash day, the markets do tend to rally. And if we get a rally, what do we expect? Maybe a little bit of sell-off in the futures. We hit that level, possibly we rally, we move back up, and then this is in many ways like a double top right now. So intervening trough, the potential to test that zone, and I think some people will take profit around here should it happen, and then maybe sell it back off. And if this turns out to be a bit of a trigger event, even if it's not that bad, people start to question, oh, the market's overpriced, all of these things. While I still think the market can move up over the long term, it might trigger some selling down and say, okay, well, let's get to the central pivot. Now, where's the central pivot? That's the blue line in the middle here, 4,500-ish. We start to say, okay, well, what else are we going to be breaking down around there? Well, by the time this maybe happens, we might spike into the 20 moving average on the weekly as well, around that 4,500 area. This would be a very, very logical area for the market to get to. Should it close underneath, which we haven't seen on the weekly, 50 exponential moving average. I kind of feel that. I feel the 50 exponential if we close underneath, but it's not there yet. It's not time to overall panic. We just have to be cautious with the news. So I think a lot of people are saying don't buy this dip, and there are relevant reasons for that. If it turns out to be nothing, of course, you're going to be correct. Big brains, well done. But a lot of other people are saying, well, look, the market will move back up once we get more information, should it not be as bad. And sometimes being informed with information can be a very relevant, very good decision. I think that's what we're going to see here in the price action come Monday, Tuesday. We'll get more clarity into the markets. Speaking of clarity, Bitcoin and crypto continue to do what we believe they were always going to do, which is fall back down. Bitcoin's doing its classic little false breakout. Kind of moved up, didn't get past our 60 or 61. That means we will not full-term bullish on this. It's come back down to under 56, which we all expected as a community probably to occur. And then between this 52 and 56 area, we're hoping for the turnaround stories. This is where we're hoping for the double bottom. We're hoping for the change of trend lightning bolt. We also don't really want this 2050 to cross, but if it does, it's done it before. It didn't show us much. Crosses of moving averages aren't as strong as the dynamic support or resistance that they offer. So it's a great little zone for us to be looking at. I'm sure many people are trying to get bullish here on Bitcoin. You push it out to the weekly, you'll notice a nice couple of weeks of selling here, and that's not unusual. Remember, we've got that ABC going on. The distance of the first move equals around the second move. We expect the pullbacks to be similar, and then hopefully the pickup to be just as good. All-time highs, maybe even into the end of the year. We're hopefully going to see that turnaround story soon. 20 moving average also acted as dynamic support, which is great, and that's exactly where we're around right now. So Bitcoin could be looking much, much better come a couple of days of trade, should everything work out as we hope it does. Bitcoin USD shorts, well, what can we say? It's randomly higher than it was, but not anywhere near when the real whales get involved. So Bitcoin shorts is up, not something we're concerned just yet about. Continue to watch that one as best as possible. For the week ahead, look, we have so much information. We have even the big man himself, the Fed Chair Powell. He's coming out Monday, New York time, 3:05 p.m. Look at this. Bam, he comes out and has a good discussion. That'll be a big one. Watch that, guys. Bit of volatility around there. And then into the Friday, non-farm payrolls. What a huge number this could become for the markets, especially should they be getting scared about the strain. It turns out to be worse than everyone expects. If that happens, wow, non-farm employment change. Remember, it's happening, the biggest monthly piece of news, 8:30 a.m., Friday, December the 3rd. Thanks so much for watching. If you enjoyed the video, please remember to subscribe, smash that like button, guys, and we'll see you this week in the live streams and, of course, in our daily video recaps. Bye for now. Catch you then.